Uh, okay. Thank you so much. Hello, sir. Can you hear me, sir? Chairman?
Yeah, welcome, sir. You can go ahead, sir.
Okay. Can I go ahead to talk, sir?
You can start at exactly 8. I think we have about 3 minutes more.
Okay. Thank you. Okay. Okay. Good evening, all. My name is Ibrahim Taiwo Samson, and I'll be the presenter today on the November 2021 First Trades Academy webinar series highlighting the key finance act in advanced taxation. Now, please note it that the focus of this the webinar is more of we're actually focusing on the ICANN students, basically. Those students that are going for this exam by next week. We want to look at how can we, because of the changes in the tax laws and also the new finance acts that they just signed in by the government, the impact of it on the exams that they are going to hold by next week. We want to look at, okay, randomly, can we pick topics in the new ICANN pack, and also highlighting those new trend, the Finance Act, the changes, the key changes, and so on. Can we pick topics randomly and we'll take it? What of all these topics that we pick? What if we get into the exam and we see them? You know, it should be a wonderful one. And I know that by God's grace, this diet, you are going to pass this advanced tax. So basically, the topics that we are going to hold here, I picked it randomly from the ICANN pack. I picked it randomly from the ICANN pack, and I wanted to listen with rapt attention. We don't have time. We have 2 hours, and that 2 hours we are going to use it judiciously. So I wanted to listen carefully So whatever the question you have, you can drop it to attend to it later. I get what I'm saying now. So, but let us judiciously utilize the time. Once again, I'm Taiwo Ibrahim, and you're on the platform of what of First Choice Accurate Success in that First Choice Academy, the best tuition house as far as professional exams, ICANN, ACCA is concerned. So please let us go on. Now, you can have it like advanced taxation for ICANN candidates. So I pray by God's will that this exam will be a done deal. So these are the topics highlighted. I mean, for these discussions, we are going to have it today and tomorrow, 2 hours. So let's have it. The first topic highlighted happens to be taxation of digital economy. Taxation of digital economy. The second topic is ethics and professionalism in tax management. And the third one is what current issue and emerging trends. The fourth one is tax incentives. The fifth one is tax audit and investigations. The sixth one is merger and acquisitions. The sixth one is base erosion and profit shifting. Seventh one is regional integration and trade blocks. And also, we also have a capital gain tax. Next one is basis of assessing company to tax. And the next one is the company income tax. The next one is pioneer legislations. And the last one there is what petroleum profit tax. Now, in the course of discussions, whatever the changes that we have currently, we try to highlight it as much as I can. I will highlight it as I'm talking. So as you know that nobody can claim the custodian of knowledge, what we are doing today is to assist the students to pass in this exam. And I know that we're going to pass. So let me start. Let me not waste the time. Let me start from the first topic I have here. I will take it and I will be very brief and concise. I get me as much as we can take today, we'll continue tomorrow. So today, let me start from the first one, which is taxation of digital economy. Taxation of digital economy. Why I decided to choose taxation of digital economy was that in the last syllabus, they added about 3 topics to the syllabus, not the current one that they are having now. They added digital economy to the syllabus. They added regional integrations. Economic and regional integrations, and also they had base erosion and profit shifting. Those are the basic 3 topics they added in the last syllabus. But fortunately, unfortunately, what the examiner tested, they tested regional integration about 2 times. I mean, back to back. Now, and they left out digital economy and the base erosion and profit shifting. So I hope that, okay, that's more reason why it's okay. Let me start from there. Let's see what this diet will look like. So let's quickly look at the digitalization of digital economy. So please note, the materials we use happen to be the current materials that you have, your current ICANN pack. I get what I'm saying now. So let us just look at it and briefly within the next 10-15 minutes, let us look at what is taxation of digital economy. What if you get into exam and the examiner asks these questions and they ask some taxation of digital economy? What do they mean by that? Now, the summary of this topic, taxation of digital economy, is to highlight those problems that are involved in taxing companies that are digitalized, that are taxing company in a digitalized environment. What do I mean by this? It means that what are the inherent difficulties in taxing a company that are existing in a digitalized environment, or that taxing a company in a situation where most of the business transactions are done on internet? I hope you get what I'm saying now. You know very well that if you are doing business on internet, if you are using internet to run business, then it will be a bit difficult for tax authority to track transactions. I get me for tax purpose. I get what I'm saying now. So tracking transaction for tax purpose, because the environment is digitalized, I get it, is what they are trying to explain to us under this topic. I get what I'm saying now. Now, it simply means that if we have an economy that is digitalized, it simply means that that economy is being run on what? On internet. It means that we are using internet to run the economy. Most of the transactions are consummated on mobile devices, on internet as well. So what are the inherent challenges of of tax authority in taxing this kind of environment where businesses are done on what on the internet. That's what is the main focus of this topic in the syllabus. Now, if you look at it, when we say digital economy, look at it, it can be defined as an economy that is enabled through information communication technology. As simple as that. So there is nothing, we don't need to blab too much on it. Any business, any economy that is thriving on what, or is premised on what, on the use of what, of ICT, information communication technology, that buying, selling, sending, receiving are done on what, on the internet, then we say is a what, that economy is what is said to be a digitalized economy. We want to ask ourselves, is Nigerian digitalized? Now, we are not there yet, but I think we are moving there. So economy that is digitalized are economy that are thriving on what, on the internet. So there are features of this economy, as highlighted in your ICANN pack. If we say, we can also call this economy, we can call it internet economy, we can also call it new economy or web economy. All these are what are other names you can call economy that thrives on what, on the internet. So by and large, the focus of this is what are the challenges of taxing a business that are being run on what, on internet, a business in a digitalized environment. That's the focus. Now, let us now look at the content now. The content that we are looking at now is that they now say, what are the features of a digital economy? If we say an economy is digitalized, what are the features? What are those things you will see there? One of it is digitalization and intensive use of ICT. Any economy in which ICT is prevalent, we are using communication technology, we are using internet, we are using computers to run the business transactions. We say what? We say the economy is what is digitalized. Also, codification of knowledge. That is, knowledge is what is codified in such a way that there is a clear-cut rules of assessing what knowledge. I get it. It's not just on the part of it. There's a clear-cut ways of what of assessing knowledge. Then we say it's an economy that thrives on what, on the internet, and it's the digitalized economy. Also, transformation of information into commodities. Information is very key, very essential in a digitalized environment, and also new ways of organizing work and production. So there is a new way, there is new normal in how business transactions are being consummated. So these are the features of a digitalized digital economy. So examiner asks us, what are the features of a digital economy? You can be able to tell them that when there is an extensive use of ICT, knowledge is codified, information is very key in that kind of environment, and new ways of organizing work and productions. Now, let me now cascade it down to the content of the topic. Now, taxation of digital economy. Now, the focus, as I said earlier, of this topic is to look at the peculiarities of taxing the digital economy and its inherent difficulties with possible solutions to these problems. I hope you are getting me now. What are the peculiarities of taxing the digital economy, and what are the inherent difficulties of taxing this economy? Firstly, in a highly digitalized environment where most of the transactions are on internet, it becomes very difficult to tax transactions because digital transactions sometimes require no physical presence. So the major issue regarding taxing a digital economy or taxing businesses in a digital environment is that most of these digital transactions, most of these transactions that are done on internet are what does not require physical presence of that person that is transacting. It simply means that the person that is carrying out that transaction mostly are not physically present in where that transaction is being consummated. I hope you get what I'm saying now. It simply means that if they are not physically present in an area where the business is being going on, and they are deriving money from that area, then how do we track them? How do we ensure that they are liable to taxes in that environment? I hope you are getting it. That is number one major issue regarding digital economy. It simply means that digital economy transactions are mostly a situation where the person that is initiating the transaction are not physically present at the point of that transactions. I hope I get what I'm saying now. But the transaction will go on, will be successful, money will exchange, value will exchange, and money will be paid. And to now tax that person will now be a major problem. Now, that is one. physical presence. Two, another major problem is to determine whether tax on cross-border transactions should be paid to where value is created or where value is consumed. When you have two countries where transactions are going on, US, Nigeria, I hope you get what I'm saying now. If a value is created in US, they transfer the value to Nigeria. They consume the value in Nigeria. Then where is it going to be taxed? Where is that value going to be taxed? Are we going to tax that value in US or we're taxing it in Nigeria? That's more of a problem also. Cross-border transactions. I get what I'm saying now. Is it where the value is created, where the product is produced, or the value is actually initiated, or where the value is being consumed? I hope you're getting me. At what point is that transaction going to be liable to tax? Is it at where the value is created over there, or is it at where the value is consumed here, or is it both? I hope you're getting me. These are issues. I get it. So you can see the way you marshal your point to the examiner now, because it's a theoretical, and you have to be careful in giving them the point. That the first challenges or issue there is what is physical presence of the person that is initiating the transactions is a problem. To track the person is not physically present. The second one is what? The cross-border transactions. Are we going to tax at the point where the value is created or where the value is consumed? I get it now. So that's another second major point you need to take note in the exam. Now, in your material, they now said that Nigeria is actually trying to handle this issue of digital transactions so that they can curb these revenue leakages. I hope I get what I'm saying now, so that most the people that are involved in carrying out these transactions are duly liable to paying tax in Nigerian territory. I said they are doing well, but they now highlighted that what actually necessitated speed up the digital transaction in Nigeria was actually one because of the commerce. Look at it. Honestly, Nigeria seems to have made significant progress in the taxation of the genesis of the general challenges of taxing digital transactions emanated from the advent of e-commerce. Nigeria, recently by e-commerce, where you can buy online, Jumia and all that. You be in the comfort of your house and you buy. That's one. Recently we're actually having that in place. That's one. Also, coupled with the fact that cashless policy of CBN. CBN also brought out cashless policy that is if you want to transact, you can do it on mobile devices, and you don't need to carry physical cash. I guess these are the two major things that actually sped up the activities of digital transactions in Nigeria. So you should know that. You can see my point. The way I'm marshalling my point, I explained what digital transactions, what are the problems. Taxing them is very difficult because of the use of ICT. And I explained what are the major issues regarding digital transaction, physical presence of the person that's carrying out the transaction. That's one. And the second one is how do we tax them? Is it at where the value is created or where the value is consumed? All these are what we highlighted. Yeah, and we also say what actually sped up the digital transaction in Nigeria is the advent of the e-commerce and also the cashless policy of the CBN. Now, you need to also understand that a non-resident company operating in Nigeria are only taxed based on the profit made in Nigerian territory, based on our law. So it means that a company that is not registered in Nigeria, but operating in Nigeria, are you getting me, would only be taxed to the extent of the activities he carried out in Nigeria. That is noted. That is according to our law, Section 13 of Company Income Tax Act. Please note what I'm saying, that our law, specifically Section 13 of Company Income Tax Act, highlighted that a non-resident company, a company not registered in Nigeria, can only be taxed in Nigeria to the extent of the profit he made in Nigeria. That's one thing. It simply means that any non-resident company in Nigeria will only be taxed to the extent of the activities is a profit he made in Nigeria. It means that he has to be physically present in Nigeria. Now, that now brings to the question: what about if it's a foreign company there's a company outside Nigeria that is now making profit from Nigeria based on his what? Based on his activities in Nigeria. I hope you understand what I'm saying now. So I'm actually saying that what about if it's now a company in abroad that is now sending goods or transacting with Nigerian people and is making money out of Nigeria? How can Nigerian Federal Inland Revenue Service, how can they track that kind of business? Are you getting me? That simply means that section 13 of CETA, which is saying that before you can be seen to be taxed in Nigerian territory, you must have seen to be physically performing the activities in Nigeria. Will not be taxed based on the money he made in Nigeria. I hope I get what I'm saying now. That is obvious because that section 13 of CETA actually prevented the FRS from annexing the tax revenue from foreign company. So majorly, why this topic is also is what is actually highlighted in your syllabus is that this the act is actually the Company Income Tax Act of 13 of Company Income Tax Act actually allowing these foreign companies to go scot-free. Let's say, for instance, we have a foreign company that is having a foreign company that is actually dealing with software, and this foreign company reside over there in US. Now, he's dealing in software and he transfer the software to Nigeria. What will he need to do? He just with the Nigerian person that is buying it, you just need to download this Nigeria. Is that not? Because you don't need that person or the person selling it to come to Nigeria for you to get the service or to get the software. So you download it here, you wire the money back to you. We now want to see at what point will the FRS track that kind of transaction for tax purpose. Now that simply means that people are making money from Nigeria because they are economically exposed to Nigerian people, but they are not liable to Nigerian tax. I hope you get what I'm saying now. So that is not the major focus of this topic, that we have foreign companies making money from Nigeria just because they are using internet and the economy is digitalized. They are making income from Nigeria and they are not being liable to Nigerian tax system. You can look at it. Example is when a company is in USA selling a software to Nigerian citizens via internet. The software will be downloaded in Nigeria and the money will be wired to the company in USA. I get it, which means value exchange hands without paying payment of tax. I get it now. So that is very significant in this explanation when you are doing that in the exam. So not to blab too much. Now, the focus of this is that what is allowing this foreign company to make this money without being taxed in Nigeria? It is this section 13 of CETA. So if you are in exam, now if you are arguing, if they bring anything under this topic, you must, one way or the other, quote this section 13 of CETA, which is saying that a non-resident company can only be taxed to the extent of their fees or to their business activities in our country. I get it. And this CETA is also saying that you must have seen to be physically performing the activities in the country before you can be liable to Nigerian tax liability, which means that any foreign company that is making money from our country will not be liable to tax in our country because of the provision of this section 13 of CETA. Now look at it. Recently, there are progresses made on tracking digital transaction by FRS. But section 13, in the ICANN part, they made mention of this about 7 or 8 times. Section 13 of CETA has made it difficult for FRS. Look at it again. I'm saying it again. Section 13 of CETA has made it difficult for FRS to establish liabilities to such foreign companies to Nigerian government. So that is most important. Now, to ensure that digital company do not escape tax in Nigeria. Now, because FRS have now seen a loopholes in that tax laws, and that tax laws have not been changed. Now, what do they now say? To now mitigate the extent of that leakages, what do they now say? To ensure that digital company do not escape tax in Nigeria. Look at how they now put it. The FRS, which is Federal Inland Revenue Service, has often required that Nigerian company to withhold tax. Look at it. Now, okay. Nigerian company to withhold what? To withhold tax. Look at it, to withhold tax on all payments made to all the non-resident person, regardless of what? Of non-establishment of the tax person specified under the SITA. You are saying in other words that irrespective of the provision of the SITA 13, which happens to be the clog in the wheel of progress, in the collection of revenue by tax authority, the FRS mandated companies that is making payments out to non-resident companies that they should withhold part of the money and what? And remit it to FRS. Though, irrespective of what the provision is saying, that now had an issue because most of the companies now that are involved now, they're now having issue with FRS because of that statement, because they were quoting section 13 of SITA as a defense. Now look at it, this requirement has encountered resistance from taxpayers. A relevant case in sight was the case between Vodacom Business Nigeria Limited versus FRS. Now, a very good example you give to them in the exam is what is a case of what of the Vodacom Business Nigeria Limited by the FRS. In fact, they ruled it in favor of FRS that FRS can deduct that money. I hope you are getting it now. Now, based on what I've explained so far, what's the focus of this topic? Focus is that companies are making money from the country. They are not being taxed. They are going scot-free with that money. Why? Because economy is now digitalized. And what is digitalization? Use of ICT. We explained the features of ICT. We talked about the features of the digital economy. And we also talked about what are the constraints, what are those things that led to that digital economy. And we talked about what are the challenges of maximizing revenue from all these true digital transactions. And we explained that the law, SITA 13, actually happened to be a major problem in tax revenue. Now, let me now explain this before I round up this topic. Now, let me explain this, that the phenomenon of this digital economy problem is not peculiar to Nigeria. It's a global phenomenon. I hope you get what I'm saying. US, UK, India, and all these countries, they also have similar issues of tracking transactions because of what? Of tracking transactions because of the use of what? Because of use of internet. So it is not peculiar to Nigeria. In fact, most of these advanced countries have actually gone ahead to prefer an interim solution to these digital issues. I hope you are getting that. Now look at it on the global scene. There are a lot of recommendations in the world to resolve this menace of taxing the digital transactions. Some of these recommendations can work. Now, in your pack, they now highlighted some of the recommendations in the world. In fact, they highlighted the recommendation of Organization for Economic Cooperation and Development. Now, OECD recommendation, which happened to be an international organization. Also, they highlighted the recommendation of European Union recommendation. In fact, under the European Union recommendations, they talked about digital service tax. If you are reading, you can go back after the class and go and look at what exactly are the recommendations. But I'm not seeing examiner asking you to look into all this. I get it now. So the focus of the examiner will be more of what local solutions to this problem as far as Nigeria is concerned. So they now talk about the tackling the challenges. How do we tackle the challenges of this menace in which we are losing money, revenue leakages through digital transaction? They now say tackling the challenges of digital transactions and revenue leakage. Now, one, review the content of that section SITA. That in the first recommendations or ways of tackling this issue that you recommend for them in the exam is that law, that SITA 13 that is preventing us from maximizing our revenues should be reviewed. Two, adoption of creative approach through innovative tax legislations. When we say innovative tax approach, it simply means that FRS should not just be amending the tax laws the way they are used to. But they are used to amending of the tax laws. Rather, the FRS should look at what are creating new laws that can move with the trend of the changes in the global scene. I hope you're getting me now. So it means that FRS should not just be amending the existing law, but they should be creative enough to bring in new laws that can be at par with the current speed in which we have current speed in tax in the world. I hope that's adoption of creative approach through innovative tax legislations. While the third one is automation of tax administrations. While we have a tax system or tax office in which you don't have enough IT gadgets that you can use to meet up with at par with the global need. I hope you're getting me. That should be automation of tax administration and data handling and protections. Before you can say you are in that digital economy and you want to maximize the returns from that digital economy transactions and ensuring that tax is maximized, data is very important. Handling of data and even protecting data is the key factor. Another one is strategic partnership with digital economy provider. There should be a strategic partnership with digital economy provider. That means that all these InterSwitch and all these digital economy provider, the FRS should align themselves with them, should liaise with them. I get what I'm saying now, so that any transactions, inter-border transactions, can be tracked easily because they are involved. I hope so. There should be a strategic alliance with all these digital economy provider. While the next one is ratification of multilateral conventions. Any treaties between two countries that can stall this solution to this digital transaction should be ratified. I get it. That should not be a clog that should not be an impediment due to the treaty issue between two countries, because that will stall the solution preferred by a given country, most importantly Nigeria. And also there should be capacity development. And when we say capacity development, then let us train our staff. I hope that the staff will be trained so that they can keep with the pace of the economy. So that is that. Now, because I need to move from here now, but before we move in now the provision of that, the new Finance Act of 2019 now, that's now the additions now to the new ICAM Pact now. They now identify the provision of the new Finance Act on taxation of digital transactions. They now said, the Honorable Minister of Finance in Nigeria and even the governments in Nigeria, they now look into the problem of digital transactions, and they now prefer an interim solutions to this problem. I guess as contained in the new Finance Act. What did they have there? They said the Finance Act 2019 now introduced the concept of what we call significant economic presence. It means that if the examiner is asking this topic, this diet, they will ask of this significant economic presence. I'm conscious of that, unless it did not come from this area. I guess they are saying that for all these foreign companies that are using the internet to run business in our country, and they are not physically present in our country, but are making billions out of our country, then there should be a way of making them liable to our country. How can we make them liable? We can make them liable through the concept of significant economic presence. That means that if you have a US company that is abroad, in US, that is making money in Nigeria, that is doing business in Nigeria, but is not physically present in Nigeria, then we need to now establish whether it's now significantly economically present in Nigeria. That based on this level of business exposure to Nigeria, based on the economic value derived from Nigeria, can we say is present in Nigeria, though it's not physically present? That is the concept of this significant economic presence. It's majorly targeting those foreign companies that are making money, billions of naira from Nigeria, and not being liable to Nigerian tax system. So the significant economic presence is to expand the scope of Nigerian tax on foreign companies deriving income from their activities in Nigeria. So that's significant economic presence. Now, how can we say a company is significantly economic presence in Nigeria, in our country? The company income tax significant economic presence order was issued by the federal government of Nigeria. The issue is recently, and the order clarify what is significant economic presence. Now look at what they say. What the order is saying. It's saying that, look at it. The order provides that a foreign company shall have a significant economic presence in Nigeria in any accounting year, if it means that a foreign company that is making money in our country will be seen to be present in our country for the purpose of tax payment. It will be seen to be present, though he's over there, will be seen to be present for tax purpose if A, it derives 25 million naira annual gross turnover or is equivalent in other currencies. It means that if it makes nothing less than 25 million naira in a year as a gross sales from all his business activities from US to Nigeria, I get what I'm saying. That it makes 25 million naira from our people. Then we will say is physically what is a significantly economic presence in our country. Now, from any or combination of the following. Now, what are those activities that they classify that they sum up to make up that 25 million? So if he's into the following, look at what it says. If he's into the following, one, if into streaming or downloading services of digital content. When you say you stream videos, you stream, if he's into that kind of business, then, and he's making up to 25 million, then you say he's significant economic presence and he will tax him in Nigeria, including but not limited to movies, videos, music, and that. So a company in US that is into streaming or downloading, services on digital, using digital content. I get what I'm saying, and he's making 25 million naira from our country. I hope I get him in a year, will be seen to be liable to Nigerian government tax. And also, two, transmission of data collected about Nigerian users, which shall be generated from such users' activity. It means that if it also deals in what's in data management, I get to me now. Most importantly, Nigerians' information data, our people's data, and all that, manipulate it, and it makes money from it, and up to 25 million naira is also liable. Also, provision of goods or services other than those in the order, directly or indirectly through a digital platform. If it's vending any services, producing any good, provision of goods or services, is using digital platform. I get me. They also say it's going to be, and it's making 25 million, you say it's going to be liable to Nigerian government. I guess what I'm saying. And also, provision of intermediation services. I hope you know the function of intermediation services. Now, intermediation is what bank does. When you say bank collect from what? From surplus sector and what give it to what? To deficit sector. They are what? They get their interest on it. That's intermediation functions. Now, if a foreign company is carrying out an intermediation activities, and again, between Nigeria and their country, and they are making money up to 25 million naira, then what do we say? We say there is what? He's making 25 million, it's that he's significantly present in what's in our country. So what will you tell the examiner? If they ask you, based on the what's new order that they signed, explain what you mean by significant economic presence and what and give an illustrations of it. So you should be able to tell them that if the company is making a foreign company that is making up to 25 million naira from all its activities in Nigeria, including streaming or downloading of videos, transmission of data, and also intermediation function and so on, then it will be seen to be significantly economic presence in what's in our country. That is one. Now, also, a company will also be seen to be significantly economic present. A foreign company will be seen to be significantly economic present if it uses a Nigerian domain name or registers a website address in Nigeria. If it registers a website address in Nigeria, it's also seen to be significantly present. Also, as a purposeful or sustained interaction with persons in Nigeria. Look at this statement. If that foreign company is having a purposeful or sustained interaction with our people, persons in Nigeria, by customizing its digital page or platform to target persons in Nigeria, including reflecting the prices or services in Nigeria currency, or providing options for billing or payments in Nigeria currency. It means that any companies that are having a sustained business interactions with our people, and it simply that particular company or person will be liable to Nigeria to Nigerian tax, and so on and so forth. And apart from that, they now made an exceptions. They now say, which are the companies that are exempted? What are the exemptions? I get in it. Exemptions to this order of significant economic presence is that the order exempts the activities of the following foreign companies. Look at the foreign company that exempted the activities. Number one is any foreign company under a multilateral agreement. and consensus arrangements to address tax challenges arising from digital transactions. It means that if Nigeria is already having an existing treaty or agreement with any other country regarding the way this digital problem will be resolved, they are saying that that country is exempted from this significant economic presence. And that is understandable. It means that there is an existing arrangement already. So this significant economic presence will not hold water, because we're already talking. The two countries are already talking on how to resolve this digital transaction. So this order will not override that. I hope I can see. That's why they say exemptions of this significant economic presence is that any foreign company under a multilateral agreement and consensus arrangement to address tax challenges arising from the digitalization of economy, who will be treated under such agreement on arrangement. So that means that any existing arrangement that you have in another country will override this economic presence. This economic presence will not work, will not prepare. So another one is what? Any foreign company making any payment where the payment is made to its employee under contract of employment. It means that any foreign company making any payment, and the payment that this foreign company is making is what? He's making it to his employee. Company outside the country, foreign country, making what? Payment to his employee. Look at it. Under a what? Contract of employment, not contract for employment. I hope you understand the difference between the two. Now, a contract of employment is master and servant relationship. It's different from contract for employment. So if a foreign company is making a what? Transactions and is sending money to his employee under contract of employment, obviously that transactions will not attract the significant economic presence. And also educational activities, if it's carried out, and also a foreign fixed base of a Nigerian company. All these are what are the exemptions. So what do we take out of this if this topic comes out? What do you need to do? What the examiner will ask? What is being equal? What are the features of digital economy? That's one. Two, what are enumerate or explain the tax challenges of digital economy and cascade it to Nigerian situation? I get me to explain it to them. And apart from that, what are the basic way of tackling the challenges of digital economy? I get me. That's also very important. They can ask you, and also they can also say, they will also ask you, what is significant economic presence, and when do we see a foreign company is significantly present in our country? I guess what I'm saying, for tax purpose. So that also is also very important. That is very important. That's that for that. I know you see, obviously, if you listen to me very well, I know you would have picked up something from that. So you can refer back to that topic in your pack and have more information on it. I hope you are getting it. Thank you. The next topic is ethics and professionalism in tax management. I decided to pick this also because of the newness. It's just newly added. Ethics and professionalism in tax management. It looks simple, but what about if the examiner comes from this axis? That ethics and professionalism in tax management. What are they trying to say here? So let us use the next 10 minutes to talk about this ethics and professionalism in tax management. I think it was about topic 26 or thereabouts in your syllabus, in your icon pack. Now, when we say ethics and professionalism in tax management, it means that with a chartered accountant, I know by God's grace these guys are going to qualify. Now, being a chartered accountant, you should know that there are some basic, there is a minimum standard of behavior that are expected of you. I guess ethically. And when we say ethics, that's the ability to understand which one is right or which one is wrong in decision making. I hope I guess what I'm saying now. So accountants have minimum basic what acceptable level of behavior. I get in being a part of the professional, the institute. I get in now. If you are having a firm or you are dealing with a client after you are qualified, I guess what I'm saying. What are the ethics and professionalism required of you in handling your client and the work you are given? I hope I get me. That's the focus of this ethics and professionalism in tax management. Now, If that is the case, then let us now look at it. Now, there are basic fundamental principles that are required of each of the what of all the accountants in what in the all the accountants. I mean, there are basic fundamental principles that you must comply with. If you have done your audit, advanced audit, you have done CSME and all these things are contained in it. So, but I can't put it in number 26. It's very important. Now, the IASB, that's the International Ethics Standard Board for Accountants. International Ethics Standard Board for Accountants identify 5 fundamental principles and guidelines for accountants that every accountant must follow. Now, those are integrity, objectivity, professional competence, confidentiality, and professional behavior. I don't want to blab too much on that. Then you should know that IASB are independent ethical setting body of IFAC. I hope you are getting me, and they are internationally recognized. I guess they identified that these are the 5 basic principles that if you call yourself a chartered accountant, you must in everyday dealing with your client, you must have integrity. And when I say integrity, what do I mean by integrity? Let your yea be yea and let your no be no. That's when you say you are having integrity. Integrity means straightforwardness. When you are straightforward, when you say yes, it's yes. When you say objectivity, that's when your professional judgment should not be biased. When it's not biased, when you are not biased in your judgment, you are not missing things. You are having evidences to back over your decision. Then you are objective. Professional competence and due care. In the course of your work, you have to be professional and ensure that you ensure due care and your client work. Although confidentiality, you must not use information you are privy to in the course of the work to your own advantage or against your client. I hope you are getting it, because you'll be exposed to their financials and so on. So confidentiality is very key. And also professional behavior. When we say professional behavior, comply with relevant laws and refrain from all activity that will discredit the World Institute. I hope you are getting what I'm saying. That's when we say you are professionally behaved. So these are the basic IASB 5 fundamental principles. So you can look into that. I guess. Now, let us now look at the legal, based on the topic, I just highlighted it, legal and ethical issues arising from tax work. Now, if you are having a tax firm and you're having your client work, what are those legal and ethical issues that can arise in the course of you handling the client work? The examiner listed 25 of these ethical issues in your ICANN pack. Go and check it. I think 26 topics, 26. They listed up to 25 ethical issues that can arise in the course of tax work. Let us quickly look about 10 of them. One is technical competence issue. You must have technical competence for the job you are asked to do. If you are not technically competent to do a job, don't accept it. That is one. 2, failure to make reasonable inquiry. Your client gives you work and you did not make inquiry whether that particular account are actually correct or not. You know yourself that they have doctored the account. They have to go and arrange the tax payment and prepare their tax position. And you did not bother to look into the worthwhileness of that account. You just decided to go ahead and pay that. You are not reasonable. I get it. You are not doing a reasonable inquiry. The work they said is part of ethical and legal issue. Also, fee setting based fee on tax stage. You don't place your fee, the fee you are paying, you are being paid on the amount of tax you are able to save to your client. I get me that I want to, if I save 1 billion for you, 1%, 20% of it to be my fee. No, that is not an ethical issue. You should not do that. Misleading advice to client. Don't unnecessarily mislead your client. I get me. You are misleading them that they should not pay tax or they should pay minimum amount of tax. Fine, that's your work. But you should not at all time be misleading them, giving them a wrong advice because you have that information. They say it's an ethical issue. Also, personal gains. Don't use that information you are private to or your activity. You don't make a personal gains from your business or from any business transaction or any dealings with your client. And also, there must not be conflict of interest and what you should not push a client. I hope you know the meaning of pushing. When you say you poach, that's when you are using your power, your financial power to pick up another client. I get it. You want to take up what does not belong to you. I mean, because you have that power. I get what I'm saying. You have that resources so that those clients that ordinarily were your colleagues' clients, you're taking them, because we can do that. No. It's not. It's also a legal issue. Also, dealing in client funds without authority. You are dealing in your client's money. I guess, and did not give that authority. It's also a legal issue, and also confidentiality issue. Don't use information you are privy to your own advantage and to the discredit of your client. Though there are some things that when it happens, law requires you to disclose those information. But mostly information private to in the course of the work should not be disclosed. That's that. But that this is understandable. They listed 25, I've given 10. Now, what are the consequences of non-adherence to ethical issues for professional body? What's the meaning of this? If you now refuse to adhere to ethical issues, to do the right thing, deliberately you refuse, and you are a chartered accountant, there are punishments to that effect. And those are the consequences of non-adherence. What are they? What are those consequences? They can impose fine on you. They can suspend you. The institute can suspend you. They can expel you. They can withdraw the certificate. They can reprimand you. They can ask to even pay the cost associated with investigation and work and the meeting. If the cost of your case, they have to also institute a panel and all that. The cost of that panel will have to go on your bill. I hope you are getting it. ETC. All these are the consequences of non-adherence to ethical issue. That simply means that every chartered accountant must be able to comply with the fundamental principles of integrity, objectivity, confidentiality, professional behavior, and so on. Now, there are some threats. There are some things that can prevent the accountant from actually ensuring that they follow the fundamental principles. What are those things that can make you not to have integrity? What are those things that can make you not to be professionally behaving? What are those things that can make you not to ensure confidentiality? All these are what we call threats. And you get me? What are the threats? We have 5 threats. These are the threats. We have self-interest threat, self-review threat, advocacy threat, familiarity threat, and intimidation threat. These are the threats. So examiner, don't say this is audit, don't say this is CSME. Examiner specifically puts it in your syllabus. Now, when we say self-interest threat, what do we mean by self-interest threat? That a financial interest will inappropriately influence the professional judgment. Don't allow financial interest. Don't allow your financial gains in the transactions to delude your visions, to prevent you from observing those fundamental principles. If it's happening, if the gains, financial gains you want to make, is affecting you observing those professional principles, those principles, then you are having a self-interest threat. That's a self-interest. You have a self-interest in the work. You are having a personal interest, your gains. That's what is making you not to want to make the right decisions. Self-review threat. That is, when we say you have a self-review threat, a threat that professional accountant will not appropriately estimate the results of a professional on which likely when forming a judgment. It simply means that you are not reviewing the work that you are reviewing the work that you yourself did yourself. I get it now. Well, you can't be an accountant and also audit what you have accounted for. I get it. There is no way you will do it and do it right, and you will follow those principles. Why would I be the accountant of the firm and I'm also the auditor of that firm or the tax person of the firm? There is nothing I will see. If I'm auditing, I will not see anything. So that's more of a self-review threat. I get it. Or if your colleague actually really want to prepare the account and you are the one to review it, you will not see anything because you are related and it will affect your judgment. And also advocacy threats. When we say advocacy threats, it means that threat that a professional accountant will promote the client position to the extent that the professional accountant's objectivity is compromised. When you are promoting your client positions in such a way that you are even standing in gap as in legal tussle, for your client as a witness. I guess you are promoting their position in such a way that even your own independence has been compromised. Then in that instance, you are having a threat, and that threat will not make you to follow the fundamental principle, and that's advocacy threat. Familiarity threats. Now, when you are too familiar with a particular client, and you not been with them for the past 10 years or 15 years, and you even go with all them on holiday and all that. There is no way you want to observe those principles I will talk about. And that's a trait, familiarity trait, and also intimidation trait. When we say intimidation trait, that's being threatened for dismissal. I mean, if a client is saying that, and you know that that client is paying so hugely and is threatening to dismiss you, and because of that, you can be compromised. Or by getting it, these are threats, and it's intimidation threat. So in that instance, if the examiner asks you, what are the traits that impact fundamental principle? We can say self-interest threat, self-review threat, advocacy threat, familiarity threat, and intimidation threat. And you must be able to link this threat to the what? To the observance of those fundamental principles I highlighted initially, which are the words objectivity, professional career, because this threat will not make the accountant to observe those principles. That is given. Now, if there is a threat that is not making you to have integrity, then do you have a safeguard? Do you have what can shield you? So that even if those threats are there, they will not make you not to observe those fundamental principles. Those are the things we're talking about. Now, that's when we say safeguard. Exactly. In your ICANN pack, they highlighted those safeguards there. Now, what are the safeguards? Safeguards are those things that can shield the what? It can shield you and make you to what? To be able to observe those fundamental principles as highlighted by the what? By the IASBA. So that's that. What are the safeguards? Those safeguards can be divided into two. This safeguard against threat, safeguard created by the professional, safeguard in the work environment. The institute, the profession, the ICANN, they are a safeguard, they were created. Those safeguards can be one. That's safeguard created by the profession. That's one. Continue professional development requirements. It means that they require all accountants to also still be going through seminars and so on, so that they can sharpen their brain and know what exactly is the current trend in the industry, so that they can deliver what they can have professional competence to deliver the work and all that. So there should be a mandatory professional improvement. Again, that's continued professional development requirement. Also, professional standard, there should be a standard of activities. How things should be done should also be, and also corporate governance regulations. I hope you know when we say corporate governance regulation, that's the way companies should be run. I get what I'm saying, that those rules and laws that guides that will actually be fully observed. All these are safeguards created by the profession. But there is a safeguard in the work environment. In your firm, you can also have a safeguard in place that can make you to shield yourself from all these threats, so that those fundamental principles will be observed. I get it now. In those firms, what are the safeguards in the work environment? Now, one of it is a leadership and transparency. If you have a work environment, a firm, a tax firm or audit firm, that are not that the leader there is not transparent. I get it. What will happen to the followers? They will not also be transparent. I hope I get me. So in the work environment, there should be a leadership and transparency issue. Transparency in that environment. Also, recruitment procedure. They should recruit high caliber staff. If you have any staff that have been compromised, either corruption or investment or what have you, we should try as much as possible to excuse the person. I get it, because it will affect others. I hope and it will not make them to take care of this threat the way they should take care of the threat. I hope I get it. So those are the things discussed under that topic. That's another topic that I've discussed, which is ethics and professional and tax management. So what the examiner can ask us from here, as far as this exam is concerned, examiner can now say, okay, what are the fundamentals? They can use scenario to create it out, so that you can bring out those fundamental principles, and they can ask you that you should list 10 legal and ethical issues. Don't underestimate it. Don't say it's simple. 10 ethical issues is what you know that you write. I hope you are getting me. So that is very important. You can list them, and also what are the consequences can also be asked if you do not follow that, and what are the threats you can have. All these can be is a whole topic in the syllabus. They are newly added to the syllabus. That's the second one. Thank you for listening. Now, the third one is this: current issues and what? And emerging trend. Now, when we say current issue and emerging trend, what do we mean by this? Also was named. Please note that other one that we just finished now. There is no impact of Finance Act or whatever. They are just new. They are just talking about ethical issues and all that. No impact of Finance Act in that. But the digital economy have actually highlighted the impact. Please note that. Now, the next thing we are looking at is current issues and emerging trend. They newly added this to your syllabus also. Current issues, and this also is what is a new trend in the world, in the global space, regarding how taxes should be done in the world and what are the variants, what are those issues regarding global taxation and even the one in your country. I guess what are the latest development? I guess in the examiner brought up this as what they just explained in this topic was they just highlighted those developments and they explained them. So if you go and look at their open-ended questions, what they asked is that they listed it again in those open-ended questions and they asked to start explaining them, I guess, as a full mark. Again, so if the examiner mistakenly come from here, I guess he should be able to attempt it and be able to get your maximum mark because you are in this class. I guess. So let us look at the current issues and emerging trend. Now look at it. The focus of this topic is to update tax administrator knowledge of the impact of current wave of globalizations and technological revolutions, its impact on businesses and their attendant consequence on international tax. Let me go over it again. That the focus of this topic is to update tax administrator, to update their knowledge. All these those people that are in the corridor of taxation, I guess, to update their knowledge of the impact of what are the latest developments in the world regarding taxing, and also current wave of globalization and technological revolution, and those technological revolution, their impact on businesses, and even attendant consequence on how tax is being done worldwide. I hope you're getting me. So, what are those issues? Now, the examiner listed some of these issues. I will explain to the best of my ability, so that when you get into this exam this time, you should be able to attempt it. So it's very important. And look at the items and comments. Look at it. Now look at it. Now, let's look at the current issue. What are the current issues? Let us just look at the current issues. I asked them to list it for me, just in summary. Now, the current issues are now: 1, tax inspectors without borders. That's TIWB. So in the exam, examiner can put tax inspectors without borders. That's TIWB. Tax inspectors without borders. The second one is cooperative compliance. That's CC. That's CCWC. Cooperative compliance. The third one is common reporting standard. That's a CRS. The next one is what? Foreign accounts tax compliance. That's a FATC. I get it, or call it FATCA. Foreign account tax compliance. And the next one is mutual agreement procedure. That's a MAP. Mutual agreement procedure. The next one is country by country reporting. That's a CRCB, a CBCR. Country by country reporting, CBCR. Country by country reporting, CBCR. And the next one is African Continental Free Trade Agreement. African Continental Free Trade Agreement. What about if the examiner comes from this area? What will you do? Let me take water, please. Thank you. Now let us quickly look at those current issues. Now, the first one is what is tax inspectors without borders. Now, without missing word, what you just need to tell the examiner quickly, immediately you see tax inspector without borders, is that it's a joint new initiative of United Nations Development Program and Organization for Economic Cooperation and Development. Please start your explanation with that this initiative of TIWB was actually brought up by what? By the UNDP, a joint initiative of what? Of UNDP and OECD. Please, I want you to follow my instructions. If you are explaining this, tell them the genesis of this tax inspector without borders, that it was actually a joint initiative of the UNDP. UNDP is a United Nations for Development and Program, and also OECD is Organization for Economic Cooperation and Development. They are the one that initiated it. And what is the aim of it? You don't need to blab too much, just go straight to the point. The aim of it is to provide assistance to developing countries to build tax audit capacity. It is all about having a developed country's tax authority, helping developing countries tax authority to what? To develop their what? To build their tax audit capacity in such a way that what? The way taxes are being managed, the way they collect taxes, the way they audit taxes, and so on, they will be able to share experience with them, from them. They will be able to get practical experience from all these developed countries. I hope you're getting me now. When we have a developed country, their tax authorities, coming down to the level of what? Of sharing experience with the developing country, so that they can what? Developing tax authority of developing countries, so that they can what? They can build tax audit capacity. Are you getting what I'm saying? So that their capacity to what? To audit tax activities and all that will be what? Will be improved, and they will be able to increase their revenue base from taxes. So that is this. Look at my explanation. It was actually a joint initiative of what? Of the UNDP and OECD. That's one. Two, the essence of it is to provide assistance to developing countries to build their tax audit capacity. They want to see those keywords there. Tax audit capacity. And under this tax inspector without borders, tax audit experts, those experts are from developed countries now. They work along with local officials, that's local FRSA, of developing countries. Nigeria is a developing country. The tax administrations, current direct and indirect tax audits, and audit-related issues concerning international tax matters. So it means that tax experts from developed countries, they are now working together with the tax officials of developing countries like Nigeria to build their audit tax capacity and also assist them in most of their international tax matters. I mean, giving experience to them based on what they have garnered over time because of their developed nature. Now, that is what that initiative is all about. Helping developed countries, helping developing countries in tax audit capacity. Now, what are the specific activities that they are assisting them to do? These experts. What are the specific activities? One, we will list about 2 or 3 for them. Pre-audit risk assessment and case selections. How do they do pre-audit risk assessment? 2, investigatory techniques. Assisting them on what are the techniques or best techniques of investigations. And also audit case involving transfer pricing issue. I hope you know that transfer pricing is a major issue also. The rate at which, the price at which companies within the same organizations are getting the transfer goods, are getting the transfer price. And you know that most companies, most multinationals use these transfer prices to what? To reduce their tax burden in a country of choice, depending on what they are trying to do. I hope you're getting it now. That is also a major problem. And through tax inspector without borders, these expatriates will assist the tax authorities of developing countries to tackle this problem. To assist them to share knowledge so that henceforth they will be able to manage this tax transfer pricing activities, and also anti-avoidance rules, so that they will also help them in looking at the anti-avoidance rules, so that companies will not necessarily be carrying out anti-avoidance activities for the purpose of reducing their tax liabilities. While the last one is sector-specific issues relating to e-commerce, financial service, or telecommunications. Now, each sector, either telecom, whether financial services, whether e-commerce, specific issues, tax issues there, they will highlight it and they will be able to assist them with it. That is also what the focus of the tax inspector without borders is. Now, if you now get to the exam, an examiner now asks you, what is tax inspectors without borders? You should be able to tell them that Tax Inspectors Without Borders is a what? It's a joint initiative of UNDP and OECD. That's one. Two, the aim is to provide assistance to developing countries on tax audit capacity. That's two. And in that arrangement, tax audit experts in this developed country will assist and share experience with tax officials of developing country in issue of what? Of international tax matters. That's three. And four, those areas of what? Of focus will be periodic risk assessment, investigatory activities, audit case involving transfer pricing, anti-avoidance rules, and also sector-specific issues. I hope you are getting this. All these are what we call sector tax inspectors without borders. If you understand that, just say hi. I want 2 or 3 people to say hi to me. I mean, to just say yes on the platform, so that I will know that I'm with you guys. Just say yes on the platform, please. If you understand the tax inspectors without borders. Okay, thank you. Okay, so wow, I have so many. Wow, that's massive. Thank you so much. Yeah, that's good. I pray that success will be ours desired. This tax should not be an issue, because irrespective of whether we have a new finance act or not, I know this exam will be a done deal this time. Yeah, I know it will be a done deal this time. Thank you. Let's continue, please. That's okay. No, that's okay. Thank you. Thank you. Now, that's tax inspectors without borders. Now, after I explain tax inspectors without borders, the next one is what? Cooperative compliance. Cooperative compliance, CC. Assuming in the exam, the examiner asks you cooperative compliance. What is it? This is a tax planning strategy. It takes the form of relationship between the revenue authority and taxpayer, with the objective of agreeing actions that ensure taxpayer is tax compliant in an uncertain and controversial tax situations. What does that mean? Is it that sometimes that it always happens to the multinationals that there are some controversial transactions, that the position of that company will be different from the position of the FRS, in which FRS will give a position that this is how this thing will be taxed, and they will give a position that is wrong. It's always a concern year in, year out of how to tax that transactions, because they are controversial transactions. Now, and this always stall the payment of taxes by all these companies. I hope you're getting me. So the initiative now comes from the tax authority that why can't we have a cooperations with these companies that we're having that issue with? This cooperation is what we now call cooperative compliance. That this cooperation will be such that those controversial issues, they will go into confidence, will go into agreement with them, into discussion with them, even prior to the time they are to pay tax. And they will try to resolve the issues amicably. Are you getting me now? So that immediately they resolve the issue, it will now be so clear to the two of them, to both FIS and the other party, and it will be easy for this taxpayer to pay without any problem, because there has been a mutual agreement, there has been an agreement or discussion on that controversial circumstances, and they would have resolved those issues. This initiative of having a relationship between the revenue authority and the taxpayer, with the objective of agreeing actions that ensure that the taxpayer is tax compliant in an uncertain and controversial tax situation, is what we call cooperative compliance. If I were to be in the exam, I would say cooperative compliance is a situation in which the tax authority goes into discussions with the taxpayers on some controversial issues, controversial transactions, so that they can seal the agreement and they can have a consensus at them on the way that transaction will be treated, so that they can make those taxpayers to be tax compliant without unnecessary hassle. That agreement is said to tax cooperation is called cooperative compliance. And the aim of this cooperative compliance is to ensure that a business is fully tax compliant through a preventive dialogue with tax authority. So you can see the word, use their term, preventive dialogue with tax authority. It means that there will be a dialogue between the taxpayer and the tax authority to prevent issues from occurring, to prevent any issues that will make the taxpayer to be not to be tax compliant. That's cooperative compliance. That resolves that. So when we say cooperative compliance, is a cooperation between the taxpayer and the tax authority to have a preventive dialogue with the tax authority in such a way that any controversial tax issues will have been resolved before the payment of tax. That's the second one. The third one is common reporting standard. If a country signs into a multilateral competent authority agreement on the common reporting standard. Now, look at the meaning. Before you can explain this, you must first identify that agreement that a country must sign it before that common reporting standard will be binding on it. I think that's the best way to quickly explain, to explain into to the examiner, that there is an agreement called, there is a treaty or agreement called Multilateral Competent Authority Agreement, MCAA agreement, on that common reporting standard. If a country signs on that agreement, then that common reporting standard provisions will apply to that country. I get you now. I think Nigeria recently signed it also. I get what's the focus of that common reporting standard? This agreement will mandate the country and certain individuals and certain types of entities with another country's tax authority. This is just a kind of exchange of information between tax authority of Nigeria and tax authority of US. I hope you're getting me now. It simply means that if Nigeria signed into that multilateral into that agreement, which is the FCA agreement, Multilateral Competent Authority Agreement, it means that FRS in Nigeria will have to automatically share information of other countries' residents in the country doing business in our country. They will share that information with the tax authority of that other country, and that other country will share tax. They also share information, mostly bank information, of Nigerian residents in that other country with Nigerian tax authority. That is an automatic exchange of information. And the reason for doing this is to prevent tax evasions. I hope I get what I'm saying. So that they will be able to capture the transactions or the details, the bank details, and so on of those individuals. Look at it. This agreement will mandate the country to automatically exchange the bank account information of individuals and certain types of entities with another country's tax authority. That simply means, bank information is a very sensitive information, but if there is an agreement between these two countries, which is a multilateral competent authority agreement on corporate reporting standard, then there will not be any problem regarding exchange of information between Nigerian government and that other country's government. It's just a reciprocal transactions. I get what I'm saying now. So that we can see into the bank details of most of these selected individuals. I get it. So please note it. All the banks in each of these countries will collect the required information and to their tax authority. They will send those required information to their tax authority. Now, the relevant tax authorities now will then collect those information that relates to Nigeria and other countries that they have agreed to share information with and share it. It means that it is more of I share my information, the information of these citizens, of these individuals with you. You should share the information of individuals in your countries with us, so that we can keep a tab on the banking details of these individuals. Then, in that instance, we are having a common reporting standard. So, in the exam, when we're explaining, you can refer back to your textbook and get more information. I've given an insight. If you are looking at common reporting standards, is a country is more of what a standard that emanated due to the signing up on a multilateral competent agreement on on corporate reporting standard, and it is more of the automatic exchange of bank information. Please note that. The next one is what is FATCA. Examiner can come and ask you to explain all these things. What is FATCA? FATCA simply means Foreign Account Tax Compliance. This FATCA is actually peculiar to what? It's actually peculiar. It's peculiar to U.S. citizens. I guess it's more of U.S. thing, you know. And let us look at what exactly the context is. FATCA is a tax laws that compel. Look at the way you explain it. So, it's a tax law that compel U.S. citizens, home and abroad, to file annual reports on any foreign account holding. It means that any U.S. citizen, either in U.S. or outside U.S., I get me now, they are an account they have of a foreign account of account holding, or their foreign account holding. What are those the accounts they held in other countries? The FATCA is a tax law that compels them. It's under compulsion that they must file that tax returns. That's one. Two, it requires these U.S. taxpayers to report yearly all assets held outside of the country. It means that if a U.S. citizen and you are outside the U.S. and you are making money or having assets or resources outside U.S., there is a way that will be filing that you have to make back to your home country. I get me under compulsion. I get what I'm saying. And there is a way they tax that for those assets. I hope they have their way, the modules, the modalities of that taxing. But that taxing, the purpose of that taxing is to stimulate job creation in U.S. I hope you're getting me. If you look at it, said U.S. uses this to increase its revenue stream, which is used for job stimulation. So in the exam, FATCA is a tax law that compels U.S. citizens, home and abroad, to file an annual report on any foreign accounts they hold. And also, if they refuse to do it annually, there are penalties. So their penalties are imposed on U.S. residents who do not report their foreign account holdings and asset that exceeds $50,000 in value in any given year. And also, FATCA seeks to eliminate tax evasions by American individuals and businesses that are investing, operating, and earning taxable income abroad. It's all about a way of preventing them from evading tax. And if you are having a foreign account holdings of up to more than $50,000, then that foreign account tax compliance must also be fully complied with. It means that you must yearly file a report. And on a yearly basis of all your holdings in outside the US. That's FATCA. The next one is mutual agreement procedure. Now, this is simple. Mutual agreement procedure. What does that mean? What's the meaning of the mutual agreement procedure? When we say mutual agreement procedure, the focus of the mutual agreement procedure is that this is a dispute resolution mechanism established. Let me just explain it. Now, when we say mutual agreement procedure, the focus of mutual agreement procedure is this. When we have a business owner that is running his business between two countries, maybe Nigeria and Ghana, and there are some issues or treaty or laws or the way a transaction will be treated between the two countries in which the two of them have not actually concluded on what to do. They have not reached a consensus. They have not reached a consensus of how those transactions will be treated. I hope you are getting me now. They've not reached a consensus of how the transaction will be treated. So if that is the case, they've not reached a consensus of how it's treated. And, I am now operating between the two countries. My business is there and there, So if that transactions now, if they are not to treat the transaction, so far there is no consensus on it between the two countries. And I've been saying it that it's going to affect me significantly. It's going to make me to pay more tax, to have more taxes paid. I get it. Then this mutual agreement procedure will give me that privilege to call the responsible officials in Nigeria, which is my home country, my tax authority, to liaise with the responsible officials in that other country, in Ghana, to what? For them to come into a conclusion on how that transaction that I think is going to affect me will be treated. So that I will not be negatively affected because of the non-consensus of the two countries. That agreement that allows you as a taxpayer in Nigeria to summon the tax authority in Nigeria to relate with the tax authority in Ghana, so that they can find the logical solutions to the problems of that particular transaction, is said to be what? Is said to be mutual agreement procedure. It means that if the two countries sign on to that mutual agreement procedure, it will be easier for the resident or citizen of the country to summon his tax authority to discuss with the other tax authority on that issue that are peculiar to him, that are going to affect him and going to increase his tax burden. That is all what they mean by mutual agreement procedures. It's also a new development. If you look at what they said, this is a dispute resolution mechanism established in tax treaties enforceable in Nigeria. Through MAF, a Nigerian taxpayer may request a company. You can read that. That's what they said. So we can continue from that. Let us look at country by country reporting. Now, when we say country by country reporting, I think they said this one lately. I mean, maybe about 3 or 4 diets. I think they even put that as the number 1 question. Now, country by country reporting is a report that provides certain financial information about each member of a multinational enterprise group. It means that if you have a multinational enterprise that are having their activities all over the place, I mean, all over the world, I get me now. A report they are requiring them to prepare by the FRS, by the local tax authority, that report, which will provide certain financial information about each member of the multinational enterprise. That means they are having about 6 members in the world. They want to see some certain information about each of the components of that multinational. That report that will help us to elicit those informations, I get me, so that we can see at a glance what are those details of these companies. Is said to be the country by country reporting. So when I say country by country reporting, it's a report that provides, the way you explain to them, as simple as that, just say a report that provides certain financial information about each member of a multinational enterprise group. Those informations that you can now list it to them, you can list 5 of them to them, 5 of the information that you require under the CBCR. I guess what are the information? The first information is what? The information to be disclosed in CBCR are profit or loss of each of that component of that multinationals. That's profit or loss before tax, income tax accrued, the stated capital, number of employees of each of these components, with earnings, tangible assets of each of the entity within the group. All these are the information that will be contained in the CBCR. I hope you are getting me. So please, it's as simple as that. It's just an information that are required of the worth of this multinational group. I get you what I'm saying now. Of the confirmations will be that of the worth of each of their components. So at a glance, a tax authority can have access to these informations, and they can even see easily whether there are malpractices or sharp practices by these multinationals. I hope you are getting me, because in that information, CBCR information, it will be easier for them to add 1 or 2 together to see the movement of the way they are manipulating or their manipulative tendencies. Okay, that's very important. The last one under this topic is what? Is African Continental Free Trade. And when we say African Continental Free Trade Agreement, now you need to be very cautious when you are explaining this. That African continent is more of Africa, is more of a free trade. When we say a free trade, that's just when we say a free trade is an area or region in which a group of countries are signed that a free trade agreement and maintain little or no barriers to trade. It means that an area in which countries come together to reduce trade barriers. Custom duties, excise duties are reduced or even eliminated, so that there can be business transactions, easy business transactions between these countries. I hope you get what I'm saying now. If we have that kind of agreement, I get what I'm saying, then you say we're having a free trade area. I get me. So there is a particular free trade agreement, area agreement. There is a particular free trade agreement that we have recently, and that is African Continental Free Trade Agreement. And that free trade agreement is a free trade area founded in 2018. They explained it, and they said 54 countries out of the UN African Union nations, out of the 55 African Union nations, 54 out of them are actually signed up into that agreement. I hope I get what I'm saying now. It means that they are Africa. In fact, they are the largest in numbers now of a free trade area. I hope I get what I'm saying. The largest free trade area that we can ever have in number. I guess with that countries coming together to ensure that they have a free trade, they ensure that they have their businesses going on without impediment within their region. I hope I get what I'm saying. And that is what African Continental Free Trade Agreement. And also the free trade area is the largest in the world in terms of the number of participating countries and so on. Now, this agreement there's an agreement, they signed that these 54 countries will do trade, and they are all Africans. They will do that they will ease or lessen the restriction in trade between the countries that are involved or member nations. So what are the objectives of of the agreement? It creates a single market, deepen the economic integration of the continent. In Africa, it deepens integration, it deepens the cohesiveness of those member nations, and also it establishes a liberalized market. They can deal with whatever businesses can go on without any impediment. And there's also that agreement also aid the movement of capital and people, facilitating investment. People can move within that member state. Are you getting me? And also facilitate investment and also move towards the establishment of a future continental customs union and enhance competitiveness of member states within Africa. So all these are our objectives. The examiner can ask you that what are the benefits of this agreement? Benefit is that it creates liberalized market. I said it the other time. You can do businesses at ease, and also contribution to the movement of capital, and also it facilitates investment through the creation of a large market. There are a large number of countries that come together, that came together to form this agreement, this free trade area, and it means that it facilitates investment through the creation of large market, and it serves as a catalyst to the introduction of new technology to boost productivity. So this agreement, what you just need to know is that it happens to be the largest in number of countries, and it's also to create an enabling environment for those member states and reduce tariff, create a free trade area, so that the members can also participate, and it's going to benefit the country, the countries that are involved. I hope that gets me. This is very instructive. So those are about seven new trends that they highlighted. So in the exam, what would the exam ask? They will not ask anything than asking you to explain what I've explained. If the question comes, it will be a whole questions, and it will ask you to just explain those 7. And you can even say 7, you can even say 5. Most importantly, this last one I just explained, this continental free trade, is a very important one. Thank you for listening. Let's also look at the next one, tax incentives. Excuse me, let me take water. In the one we just finished, we do not have any tax, new finance act implications. I get what I'm saying now. So what you just need to do is to just understand those new development globally. Now the next thing is what is tax incentives. Now I decided to put the tax incentive because recently examiners have actually been coming from these tax incentives. I get me, and some of these incentives are also being affected by the new finance. Thank you. Thank you. Now, examiners are fond of asking tax incentives. I think what you need to note regarding the tax incentives is more of you want to know what are the various incentives that are given to different sectors of the economy. I get what I'm saying now. So what is tax incentives that are given to different sectors of the economy? And when we even say tax incentives, don't forget, I've seen it severally in your exam. They say tax incentives are those special exclusions, exemptions, or deductions from income or tax credit offered to taxpayer by government as an encouragement to engage in specified activities. It's as simple as government is trying to encourage you to go into business, reducing your tax burden. I hope you get what I'm saying now. That tax burden reductions can be in terms of exclusion. They can exclude your income from being taxed. They can exempt it completely. They can even deduct part of your income, of your taxes. I guess I say you should pay lesser amount of tax. So if you're having all these benefits from government for the purpose of encouraging you to go into business, into particular specified activities, they will say that what government is incentivizing you, and that's what they mean by tax incentives. So if we have that, then what are the objectives of tax incentives? I've seen in your question, what are the basic or reason why government is giving these incentives? What are the basic? They encourage voluntary tax compliance. If they give incentives, they are telling you to want to voluntarily comply and pay tax without being told. Attract domestic and foreign investment, because incentives are meant to bring in foreign direct investment into the country. And also, it encourages investment in the private sector. If government wants to direct their investment into agriculture or into tourism, they will give a generous incentives to them, and that will steer people into that direction. And then, at a point in time, government were actually looking into the direction of agriculture. I hope you know that at a point in time, they're actually directing the world because we want to have the food security in the country. So please notice that encourage investment in private sectors and also promote export activities. If you want to have a positive or balance of a current account in terms of balance of payment, then they need to incentivize those local companies so that they can produce, not for local consumptions, for exportations, so that they can increase they can improve on the balance of payment account. So that's promoting encourage promote export and also encourage repatriation of foreign earnings in Nigeria. It means that if you give incentives, those in the diaspora, I guess they will be looking at coming in to come and invest in the country because of that incentives. And that was what encouraged repatriation of foreign earnings. Then in the exam, I don't want you to do like a layman in terms of incentives. You should be able to let them know that you have seen their material. That when we say incentives, they are in three parts. Incentives are not just the benefits you get, but they are in three parts. So if you are explaining this, you explain it this way, like it can be in terms of exemption from payment of taxes. If they are exempting you from payment of taxes, like the way they structure the new finance act in terms of company income tax now, that if a company is making less than in gross turnover, less frank investment income, is making less than 25 million naira in turnover, less frank investment income. I'm telling you, based on the new finance act, they are saying that the company is exempted now. I get me from paying tax. Not only paying tax, also paying education tax. I hope I get what I'm saying now. It means that if you're making less than 25 million naira turnover, less frank investment income, I get me, you are not to pay company income tax to government. I get it. What you can just do is you just file your returns. I get it. Not until when you get to the threshold of 25 million and above, that you now be subjected to a company income tax in the new finance act. Okay, that's an exemption of it. That's an example of exemption. They're exempting them. It was not there in the previous thing. I get it. So it's an incentive to encourage small businesses to grow. That's what. 2, reduction in rate of tax to be paid. I get me. You should also tell them that one of the forms of tax incentives is that they can also ask them to reduce the rate of tax. Now, if you look at the threshold of the company income tax, it said between 0 to less than 25 million, you don't pay tax. But between 25 million and 100 million turnover, they say you pay 20% as a rate of tax. And if you make more than 100 million naira turnover, you pay what? You pay 30%. Can you now see the gradation in the rate now? I guess me. Can you see the rate is now changing? Now that rate, that changes in the rate. That one is captured under reduction in rate of what? Rate of tax to be paid. I hope you're getting me. That's also an incentive. Another one is the grant of allowances and deductions from profits subject to tax. Now, when they are giving you capital allowance, when they are giving you investment allowance, if the government is giving a general, accelerated capital allowance, because like all these pioneer companies, I guess in the government sometimes even generate extensive capital allowance, general allowance as well. I guess what I'm saying now. So if you're having that situation, then they are granting you allowances. I get it, and deductions from profits. So this is also a form of incentive. So incentives can, if you're selling, can have in terms of exemptions, reduction in rate, and also granting of your allowances. Now, I now try to identify some of the industry that we have based on your ICANN pack. I extracted from your ICANN pack. So some of these I just pick like two incentives, so that if the examiner asks you, I write 4 incentives that is for this sector, you should be able to quickly give them points. I gave them incentives for gas utilizations. I pick incentives for tourism, incentives for energy sector, incentives for telecommunication, incentives for agriculture, and incentives for solid mineral. What you just need to look at is just to pick each of these incentives. Let's look at incentives for gas utilizations. And when we say gas utilization, what do we mean? This covers a range of projects involving marketing and distribution of natural gas for commercial purposes, and includes power plant, liquefied natural gas, gas to liquid plant, fertilizer plant, gas transmission. All these are those who are using gas for their activities. Are you getting me? So if you add that, you have an incentive for those companies that are involved in gas utilizations. And look at this, a company engaged in gas utilization downstream operations shall be granted the following incentives. I've seen it in your past questions. We they ask you to write 4 incentives for of the industry that involve in gas utilizations. Are you getting me now? Now, those incentives, just pick it there, an initial tax-free period of 3 years. The first 3 years of operations, there is what there will not be taxed. It's like a pioneer company in which the first 3 years of operations, I guess there will not be subject to tax. Investment allowance is 35%. Now, unlike in normal companies in which investment allowance is 10%, unless you have the other rural investments and all that. But basically, for companies that involve in gas utilizations, investment allowance is 35%. Accelerated capital allowance. Please don't forget to tell the examiner that companies that are involved in gas utilizations are enjoying accelerated capital allowance. And if you know accelerated capital allowance is that the first initial allowance you'll be given will be so high that you have little or nothing left for annual allowance in that first year, and even subsequent year no annual allowance. What's the meaning of that? It means that they are trying to help the company in that first year, so that you have huge capital allowance that can consume the profit you made in the first year, and there won't be any tax liability as such in that first year. I guess that's a gas utilization company accelerated capital allowance after the tax relief period that is 90% initial allowance. You know the implication of that for plant and machinery and 10% residue. They will now leave 10% until the disposal of that asset. Now look at the position of the Finance Act. The Finance Act now says, the Finance Act 2020, that's the latest review of the Finance Act, on incentives for gas utilization is to grant the incentives only to companies whose trade or business involve gas utilization. It's not just consuming gas that you want to use to cook or anything. No. It must be those companies that are called deep in utilization of gas, are those companies that are categorized under the new finance. Because before, they did not differentiate from those that are just using it for domestic and so on, and those that are actually having it as a core need for their business activities. So the new Finance Act identified that on incentive for gas utilization is to grant the incentives only to companies whose trade or business involves gas utilizations in downstream operations. The mere consumption of gas, please note it, I copied directly from your ICANN. The mere consumption of gas does not qualify for the claim of the incentives. That you're just using gas just for domestic use, it does not qualify you to have that incentives. You must have it as a core component of what you are using to drive your business. Then you say you are entitled to this incentive highlighted. That's that. If they ask you for gas utilization, I've seen it before. Next one is incentive for tourism. Those who are in hotelier industries, that you also establishment of conference centers and so on. I guess we can see recently there is a boom in water, in that sector. What are the incentives given to them? Assuming the examiner asks you, The first one is what government facilitate acquisition of land through issuance of CFO for tourism development. It means that there is an acceleration in the release of CFO for this tourism sector. That's an incentive to them because it will assist them to quickly assess land for their tourism activities. That's one. 2, 25% of income derived from tourists by hotels in convertible currencies is tax exempt, provided the income is put in a reserve fund to be utilized within 5 years for expansion of new hotels, conference centers, etc. Let us break it down. They said for this tourism incentive, they said 25% of the income. It means that if you make 100% income now, 25% of that income they derive from tourists by hotels. So it means that what they derive from tourists by these hotels in convertible currencies, they said is tax exempt. It will not be taxed. 25% of their income will not be taxed, provided that income they put it in a reserve fund, that they are going to use it for the next 5 years to expand hotels and conference centers. If that is the case, then they will give them 25% income free. They will exempt 25% of their income from being taxed. That's an incentive. So for anybody listening to me now, if you're now in the exam and they now ask you, what are the incentives for tourism? You should be able to tell them that they give their CEO on time, and also 25% of their income are exempted from tax, provided that income are actually put in a fund to be used in expanding the business or hoteling business and also conference centers. Then you have that 25% exempted. The next one is incentives for energy sector, that's power sector. Though they have deregulated that recently, but what are the incentives? If all areas in the sector are considered to be power product or industry, that's how they put it there. And they say, B, there is a tax holiday. That's maybe you should take that one home. That should be a take home on that. There is a tax holiday of 5 to 7 years for investment in that sector. So it means that if you are doing an investment in the energy sector now, you are going to have a tax holiday in which you will not be required to pay tax for about 5 to 7 years. I hope you're getting it. That's for energy sector. Why incentive telecom? Those people that are in telecom now, they give a rebate and tax relief are provided for the local manufacture of telecommunication equipment and provision of telecommunication services. So it means that if there is a local manufacturers of this telecommunication gadget, they give them a rebate and tax relief. The ICANN the PAC did not stipulate those relief. And look at the incentives for agriculture. What are the incentives for agriculture? Banks' recognition of the difference in the gestation period within each category of agricultural loans, ranging from 6 months to 10 years for crops, livestock, fish. It means that they now recognize the difference in gestation period within each category of agricultural loans. Any loans given to the agricultural sector, I guess what I'm saying, they recognize that there is the difference in gestation period. Gestation period is more when the period between when you are given and when you are going to pay back. They are able to demarcate and differentiate, I guess, in that their gestation, they recognize that when they give this particular loan to agriculture, this is the time they are required to pay it back. They give this and they give it to pay this one back at this time, and so on. They are recognized, and that recognition is more to give them incentives. I get him now, so that they will be more relaxed to ensure the productive activities. And also, companies in agro-allied business do not have their capital allowance restricted to 66 to third, but graduated to in full 100%. Don't forget that if you are relieving capital allowance, now both agro-allied industries and manufacturing business, you cannot restrict their capital allowance to 66 to third of assessable profits. No. The one that under trading business or other line of business, you cannot remove more than 66 to third of the assessable profit in capital allowance. It means that the max of the capital allowance that you can remove from profits should not be more than 66 to third of that profit. Any capital allowance in excess of that 66% of the profit, I get me, will be what? Will remain on, will not be relieved in that year, will be carried to the next year. That is for trading business. But that will not go for what? For agricultural or agro-allied business. Because they want to give them, they give a generous deduction that even if we have total capital allowance that will consume the total profit, that will turn it to loss or to nil profit, they allow them. I guess they don't restrict their capital allowance. I guess but in trading, they restrict. So can you see that it's a generous what? It's a generous benefit to them now. Hope you are getting me now. Now the next one is agro-allied plant and equipment enjoyed enhanced capital allowance up to 50%. It means that agro-allied plants and equipment enjoy capital allowance, enhanced capital allowance up to 50%. All these are what are. Now let's look at the last one there, incentives for solid minerals like gold and so on. So those companies that are involved in what the solid mineral activities. Now, what are the incentives in there? The first one is with 3 to 5 years tax holidays. Like a pioneer, deferred royalty payment. You know, if you are exploring solid minerals, you have to pay royalty to Nigerian government. I get me now. But sometimes the Minister of Finance can defer it and say, okay, don't pay it now, you can pay it the next 3 or 4 years. I hope you get what I'm saying. If you have that in place, then you have what is an incentive to them because it's a risky environment. It's possible to invest and you don't get your money back. I guess it's possible you do investments and the money will not be returned. You lose the whole investment. That is why they give them this generous incentives. So in the exam, under the incentives for solid minerals, you tell them that's a deferred royalty, they can defer royalty payment and also capitalization of expenditure on exploration and surveys. Expenditure they incur on exploration and survey can be capitalized and provision of 100% foreign ownership of mining companies. Don't forget this. Under the mining, government allowed even a total foreigner, a complete foreigner to own mining sites in Nigeria. That's an incentive. So that it can what? It can also jeer this foreigner to also come into that sector to also explore it for us. I hope you are getting it. So provision of 100% foreign ownership of mining company, 100% foreign ownership of mining companies. That is very instructive. So it's very important for you to know that. So let us now look at that for that. So what the examiner can ask here, they can just ask you to list some of the incentives in each of the sector, and they can also ask you, I've seen it in their question, what are the forms of tax incentives? You should be able to tell them that there are exemptions, that there are deductions, there are reduction in rate, and so on. And what are the objectives of tax incentives? All these are what you need to discuss. Now, apart from that, then the next one is now the tax audit and investigations. Now, this is where we are going to, this topic is where we're going to be the last one we're going to discuss, but we're not going to finish it, I'm sure, because time is already up. Now, let's look at the tax audit and investigations. When we say tax audit and investigations, what do we mean by tax audit and investigations? Now, it's also a major topic that we also need to know. It's possible that, yeah, thank you. And when you say agro-allied companies, and they are the same thing. You know, there is value chains of what agricultural activities. I get you now. There are value chains. You know, in agriculture, there are people that are involved in food, egg, people that are involved in providing food for their animals, people that are veterinary, that are providing their drugs. These are value chains. I get you now. These are allied companies to agricultural activities. I hope you get what I'm saying now. So those allied companies also, they are agro-allied companies. There are also some people that are involved in fertilizers. I hope you get what I'm saying now. So all these are what agro-allied industries. So agro-allied industries are also industries that are into agricultural activities, but they are at different stages of that value chain. I hope you are getting. So please note that. Thank you so much, Victoria, Oluwakunmi, Abiola. Thank you. I appreciate you guys. So let us go on. Now let me just quickly talk briefly on this before I move. I draw the curtain today. Now, when we say tax audit and investigations, the examiner can come from there. I get me. As simple as it is, if you look at it, when we say tax audit, I try to use charts to bring this out so that you will not need to disturb your head on the details on the story. Now, when we say tax audit and investigations, you know, when we say tax audit simply means you are what? You are independently review a particular thing. I guess it will give your independent opinion about that thing. I guess if you say you are holding an account, it means that you want your professional view about that account, whether that account shows true and fair view of what actually transpired in that organization in that period. I hope that gets me now. That is more when they say audit. I mean, that's normal audit. But when we are now doing tax audit, that is when you now cascade it down to what to auditing in the taxing, auditing of tax payment. I get me now. So most importantly, when a company is mandated to pay their taxes, I get what I'm saying, as an appointed time, else they will face penalty. But in the course of paying taxes, most of them are required to come up and be responsible citizens and file their returns themselves without being pushed. I guess that's more of self-assessment. So when they're doing this self-assessment, what would they do? They will look into the account for that year, the audited account. After they look into the audited account, what do they do with the audited account? They will compute their capital allowance. They will prepare the tax they're supposed to pay. I get me. They will raise the check for that tax they are computed, and they will take that check to the receiving bank or designated bank by the FRS. They will lodge the money into the FRS account, and they will get the evidence of that payment. They will now take that evidence alongside with the audited account. They will take it to the nearby tax office or undertakings where they are filed and domiciled. I guess what I'm saying now. So then they will now present that evidence of payment and the audited account to the officials there. Now, when they do that, they have paid the money to the bank based on what they have computed themselves. And it is possible that there are mistakes in what they are computed. Nobody's bound to me. It's above mistakes. So if there are mistakes in what they are computed, I hope I can say, so what happened? It means that the tax authority haven't received that audited account or that details. I guess we now have to peruse through those details. I guess to ensure that to see whether there are mistakes or errors or omission or commissions in the course of that account they prepare. I guess now. I mean, when the peradventure they actually see any anomaly in that account, what would they do? They will have to what? They will have to call on that particular client, a particular taxpayer. I mean, that activities that is involved in vetting the account submitted to them, to see whether the rules are complied with, to see whether there are omissions, to see whether there are commissions, or errors or omissions in that account, so that they can appropriately call on the other person, the party involved, to address that issue. Then that's what they are doing is what we call it tax what? They call it tax audit. I hope you understand what I'm saying now. So tax audit, if you look at it, or we'll say this is an audit exercise meant to enable the tax authority to further satisfy itself that audited financial statements and tax computation submitted by the taxpayer agree with the underlying record. You want to put record there, sorry for that. Agree with the underlying record. So it means that the tax authority will want to satisfy itself and be sure that audit is an audit exercise meant to enable the tax authority to further satisfy itself that audited financial statements and tax computations submitted by the taxpayers agree with the underlying records. This is where I'm going to stop today. Yes. Now, this happens to be the fourth topic, fine. But what I will do next class is I will try to go into PPT. After explaining this, I'll go into PPT and I'll go into the company income tax and hopefully pioneer legislations. I get what I'm saying now. So we'll try to manage the time. I get what I'm saying. So the materials are there. We'll try to manage the time. So we'll look at those contents, those new trends in the PPT. I deliberately wanted to go through this theory because I know that examiner will surely come also from theoretical this time. Because in the park, we have as much as 17 theories in the park. Yes. And then we have just about 14 or 13 computations. So I hope that those theories will also be tested this time. That's why I want you to go around the syllabus at the park, so that at the end of the day, we will not have a shocker. I guess what I'm saying, the exam. I guess as we are looking at your PPT, and looking at your company income tax, your pioneer legislation, your mining taxations, I get me. As you are looking at those computations, please don't lose sight of what of those theoreticals also, because your focus is to pass this exam and to what and have it this time and go. So therefore, anything there to be done should be done. I get what. So the next class I'll teach into the direction of computations by God's grace. I pray God in His infinite mercies will help us to pass this exam. Like I say, I remain Ibrahim Taiwo, and we're still under the platform of what of First Choice Academy. I get the best tuition house in Nigeria. Thank you. Thank you, my host. Thank you so much for.
All right, thank you very much, sir. Good night.
Yes. Thank you.